There are more than 1,100 tech stocks domestic to the U.S. markets. Even among the 500 largest companies in the United States, 75 of them are in the tech sector, but only 7 are the best of the best. Just 0.7%, less than 1 in 100 tech stocks made it on the list for the new BOWT index. I am excited about this new index, the ticker BOWT, an official index to follow the best stocks in the market. I'll show you how the index works, its potential to beat the market. Then I'm going to highlight those 7 tech stocks I'm buying right now. These are the stocks of companies leading their industries with a competitive advantage they can turn into profits and returns for investors. If you want to see all the stocks in the index, go to Stock Card and the Idea Center. Click on Indexes and you'll find the BOWT index. From there, you'll see the methodology I'm using to pick stocks, the videos detailing it, some great ways to contribute your own ideas, and the stocks in the index. Don't forget to follow the index to get early access to videos and be the first to see when I add a stock to the group. I showed you how the index is set up in our last week's video. The BOWT index is the top 10% of the large cap market, the best 1 in 10 stocks among the 500 largest companies based in the United States. You can see here with back-tested results, over the last 5 years, investing in these best-of-breed stocks would have outperformed the SPY fund by more than 50%, so there is definitely something here. I'm going to link to last week's video in the description below, so check that out for a complete process of how I'm picking stocks for the index. We've got a big video today, so I want to get straight into these 7 tech stocks to buy. First on our list of tech stocks is Applied Materials, ticker AMAT, one of the first in semiconductors since 1967. AMAT is a leader in semiconductor equipment and tools, really a picks and shovels play for the growing semiconductor industry. Basically, folks, there is a gold rush in semiconductors now because these are the brain at the center of any electronic device. The Internet of Things, AI revolution, it's really driving that huge demand that has taken stocks like NVIDIA, Skyworks, and Applied Materials provides the key components that go into any semiconductor. Besides the core semiconductor systems and the services it provides, the company also has a display segment of OLED flat panel displays. Revenue has been trending lower on the semiconductor segment over the last year, just because as that semiconductor market kind of slows down, but it's held fairly consistent in the other two, the services and the flat panel, over the last year. Now, if you didn't catch our first video in the series, make sure you check that out with the link below. I outlined the quantitative factors like sales growth and the operating margin that we're using to pick the best stocks for the BOWT index. And Applied Materials meets all these factors with 3-year sales growth over 25%, well above the industry average, as well as an operating margin that is nearly 6% higher than the peers in the industry. Now again, why we're looking for this faster sales growth and the operating margins is really as a clue in on the competitive advantages for a company against the peers in its industry. It's a way to measure those factors that aren't always as easily measurable. Applied Materials is growing sales faster than the competition, taking market share from them, and it's able to do that at a more profitable rate. Like a lot of the tech stocks we'll see on the list, AMAT's advantage comes from that innovation and its ability to continue to innovate. The company's $2.7 billion budget for research and development is tough to beat by smaller competitors, and it's helped it be the first in its industry changes, like the recent changes into the 3D architecture and field effect transistors. It's really allowed it to build out that portfolio of products that just can't be matched. Now, about 30% of the company's revenue is tied to China, so that escalation of the chip wars is a little concerning, but AMAT has applied for a special export license for this. A big part of the business to China is also in the flat panel display business, so rather than semiconductors, and it could mean that moderation of that loss. On a valuation basis, we find a stock that isn't overpriced like a lot of the companies in its industry. The average price to sales ratio for semiconductor stocks is 4.9 times, firmly in that growth stock territory for valuation, and a little expensive given the economic situation that we're watching unfold. But shares of AMAT trade for just 3.1 times sales, more than a third cheaper than the industry, despite being clearly one of the best stocks in its group. Analysts see a lot of upside here, with a target price of $133 a share, or about 50% higher over the next year. One stock I've been watching really closely for a recent acquisition it's made, Broadcom Inc., ticker AVGO. And through its acquisitions, Broadcom has patched together one of the broadest leaderships in tech, from smartphone components to wired infrastructure and storage to semiconductors. If you want one tech stock that is going to benefit from some of the strongest trends like robotics, Internet of Things, and 5G, this is probably it. Now, Broadcom has lagged the industry a little bit in sales growth with just a 10% annual growth rate versus 12% average on the industry. That weakness disappears, though, when you consider the company's operating margin of 31%, nearly 8% higher than the industry's average profitability. So here, because of its size, Broadcom might not be able to grow as fast as the industry, but it's one of the most efficient and can convert much more of those sales into profits. Now, coming up, the increase in network demand for the 5G technology could mean a spike in demand for Broadcom's RF filters, but it's really the acquisition of VMware that has me most excited. The $61 billion deal is expected to close next year, and it's going to add VMware's dominance in enterprise cloud market to Broadcom's leadership in infrastructure software. It's really going to fill one of the few gaps in Broadcom's business. Going to give it a strong defensible advantage on the enterprise side of IT. And now, for all the worries about Broadcom's acquisition history, basically going in and driving massive restructurings at the target companies, it's hard to argue with the success it's had for investors. Broadcom management believes it can nearly double VMware earnings to $8.5 billion over the next 3 years of closing. Analysts think the VMware acquisition can help take shares of Broadcom up to targets of $675 over the next year, more than 45% from where it trades now. We're just getting started, but I've been promising for weeks to show you the qualitative factors that I'm using to pick stocks for the index. I showed you the quant factors in our first video, but these are just as important, maybe even more so. And those quantitative factors, like finding companies with the best sales growth or profitability, those are numerical ways of doing exactly what we're trying to do with these qualitative factors. And we're saying that a company with stronger sales growth versus its competitors, or just better profitability, could have some kind of a competitive advantage or better management that's enabling that growth. They're taking the market share from competitors for a reason, because this is really what makes those strong long-term returns in a stock. It's why Amazon is a trillion-dollar company and nobody remembers Squirrel Card anymore. It's why we talk about Shopify instead of Lemonade Stand. Now, in turn, the qualitative factors like product innovation, market positioning, and strength of management, those are just more direct ways of looking at this. We're trying to find those advantages that a company has that enables that stronger sales growth and the profitability. So I do want to talk through these briefly, give you a sense of how to find these when you're looking at stocks. So here, product innovation and market positioning is how unique a company's product is and whether it's different enough to really stand out. That's going to mean a lot for the price a company can get, whether it can charge more for its products or if it has to compete on that lowest price possible. And market positioning here is important because it gives the company with that dominant position, controlling more of the market, can get that economies of scale that really drive profits. The strength of governance and management looks first at how well the board of directors really is focusing on those shareholder interests, or if they're just out there to line their own pockets. We also want to find management that's able to perform in any market and in any economy. And finally, our competitive advantages brings this all together to look for the companies with that defensible advantage that is going to allow them to take more market share or have better pricing power. Semiconductors is really where the growth is, and our next stock, Skyworks Solutions, ticker SWKS, has a history of innovation. Skyworks provides frequency components, so switches, filters, and amplifiers for the wireless handset market, along with other wireless connectivity devices. Because 5G uses a wider spectrum and band frequency, growth and demand for these components is booming and should continue to grow for years. And now, where the company used to be almost exclusively about smartphone handsets, now about 40% of its sales are in the broader markets like Internet of Things, automotive, and industrial. Skyworks grew its revenue by 23% annually over the last 3 years, well above the 20% annual growth in the industry, and that outperformance has increased recently with a 52% year-over-year sales growth in the most recent quarter. The company is able to command a higher price for its products and is more efficient in its expenses, meaning all this is it's able to turn its sales growth into earnings. And there is a reason why Skyworks is able to get a higher price for its filters. The SkyOne suite of products is really innovative in its ability to integrate several radio frequency needs into a single product, and the tech has been proven very difficult to copy by competitors. Now, that expertise and innovation is just starting to translate outside of smartphones for Skyworks, but it could mean even stronger sales as the company continues to diversify into other products. Skyworks has one of the highest potential upsides according to analysts, with an average target of $141 a share, nearly 65% higher from here. This next tech stock, Adobe, ticker ADBE, just made an acquisition that could significantly improve its reach. Now, most people don't know it, but Adobe is much more than just the PDF file provider, but a content creation, document management, and digital marketing leader. Its Photoshop and Illustrator products are the go-to in editing, and it's moving those products into the cloud for a subscription revenue model. as something that should help it smooth out its growth and build momentum. Adobe's 3-year growth rate in sales of almost 19% is more than 1.5 times the industry, and sales growth has increased further to 22% in the most recent quarter. And again, just remember, that's one of the most important factors that we're watching. Not only that sales growth is beating peers, but it's also increasing over time. Here lately, we see Adobe is doing with its Photoshop and other content creation products what it did with Acrobat, which, is now the default PDF file format and a $2 billion business for the company. There's really no alternative to a lot of these software suites, and Adobe does a great job of cross-selling them once it gets you hooked into one of its products. So where some have questioned the price tag for the recent Figma acquisition, I think it's really going to help bring Adobe into a team collaborations environment versus just kind of primarily a single user kind of product where it was before. Now, one thing about Adobe though, while shares did come down in the recent earnings, they still trade kind of on an expensive side versus peers. A price to sales ratio of 7.9 times is very high even for a growth stock and above the valuation you pay for stocks in its industry. That's probably why there's not quite as much upside here with an average analyst target of $412 per share, but that's still 45% higher for a 1-year target, and the company will continue to grow from there. We're just over halfway through the list of tech stocks, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Arista Networks, ticker ANET, recently saw shares jump 9% on news that could mean even stronger revenue growth. A little background here. Facebook, or Meta Platforms now, is one of Arista's biggest customers for its high-speed switches that the company sells to data centers. Besides just generally strong growth in the data center market and Arista's competitive advantages that I'll talk about, Meta's capital spending plans over the next year could mean a bigger revenue boost for Arista. It was bad news for Facebook investors that the company is going to be spending so much more on its metaverse projects, but great for Arista. Now, Arista has lagged peers in its revenue growth over the last 3 years, with about 10% annual growth versus 14% for the industry. But we're starting to see this turn around with 20% year-over-year growth in the last quarter versus just 2% for competitors. So it does appear that even as the economy is starting to weigh on Arista's industry, the company is doing really well and growing even faster. Now, like we saw before, I'm willing to give the company a pass on a little bit slower revenue growth if we're looking at profitability that's so much higher, because Arista's operating margin is almost twice the average for its industry, with an operating margin of 31% versus just 16% for the average. Arista took leadership from Cisco in the market for data center switches almost a decade ago, and it's really built on it since. The company now controls about a third of the market for those high-speed switches because they just perform so well at the speeds that their enterprise clients need. Another advantage is Arista's decentralized product with an open structure. And that's different from Cisco, which tries to lock customers into an ecosystem of their hardware and their software. Customers just like the flexibility that Arista gives them to build out their data centers how they want, and it's really helped grow that market share advantage. Shares of Arista jumped on the Facebook news and again on a strong earnings announcement. So since analyst targets haven't been upgraded here, that's probably why there's kind of limited upside showing, but I like the stock for a really good long-term play. I really wanted to get a cybersecurity company on the list for growth, and I'm buying Fortinet Inc., ticker FTNT. Between ransomware, state-sponsored attacks, and just general cybercrime, no industry has the growth of cybersecurity. Fortinet leads in the space with a hardware and software package along with cloud services to grow into what's expected to be a $200 billion market by 2026. Here, Fortinet blows the competition out of the water in growth with a 24% annualized sales growth over the last 3 years, 4 times the industry average. Not only is it growing faster though, but more profitable as well, with an operating margin of 19% versus 14% for the industry. The company dominates the market for firewall shipments with a 37% share of that market, nearly 3 times the size of the next largest competitor, which is Cisco with just 13% of shipments. And all this, it's being built from a leadership in that convergence of networking and security, really providing a single solution for security-driven networking through its operating system. That is a defensible competitive advantage that the company is going to continue to use to grow market share and revenue, and I think Fortinet is one of my favorites of this group. Analysts have an average target price of $71 a share over the next year, about 53% higher from the current price. I'll reveal that last tech stock next, one that I've held in my own portfolio for years and one of my biggest investments, but anytime you're focusing on a single sector like this, folks, you really want to make sure you have good exposure across industries. Remember, a sector is just a larger segment of the economy, so you've got sectors like technology, energy, and healthcare. Within each sector, though, you have industries of companies that create those similar products that serve a similar need. So within the consumer staples sector, you've got industries like beverages, food and retailing, you've got household products and personal products. Within the tech sector here, you've got communications equipment, electronics, IT services, semiconductors, software, and hardware. So in our list of the best 7 tech stocks, I've really tried to build out that industry exposure. We have 3 companies in the semiconductor and semiconductor equipment industries. We have 3 companies making software infrastructure and 1 in software application. And why this is important is the same reason you want to add stocks from different sectors to your portfolio. And focusing on just one industry means all the volatility and that risk from that one industry. And making sure you have stocks in different industries, though, and across the different sectors really is going to smooth out the risk in your portfolio so it doesn't crash along with just one group. All you out there in the Bowtie Nation probably won't be surprised by this one. One of my favorite long-term stocks, Salesforce.com, ticker CRM. This company is leading in some of the biggest themes that are going to change our world over the next decade, including AI, remote work, cloud, data across an addressable market. CRM estimates as high as $250 billion. Salesforce controls nearly 20% of the global market for customer relationship management software. That's 4 times the next closest competitor, Oracle, with just 4.8% share. So the company is able to translate that size into a real competitive advantage to drive 24% sales growth, well over the 15% average for the industry on its ability to cross-sell those products. And for one of the larger companies in the group, you wouldn't expect the upside to be as strong here, but analysts have a $216 price target on the shares, 53% higher from here. Click on the video to the right for the one energy stock I'm adding to the Bowtie Index, up 350% over the last 2 years, and I like it for even higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.